Well, hello there, dividend growth stock investors. It is Colby, the DGI Crab, and today is a big day, I suppose, because the Federal Reserve Bank, as was expected this month, have cut the interest rates not by 25 basis points, as some were thinking, but by a full 50 basis points. So pretty substantial dividend interest rate cut. But what does that mean for us as dividend growth stock investors? What can we reasonably expect out of our investments now that the interest rate has been cut? And they certainly made it seem like there's very likely going to be an additional rate cut between now and the end of 2024. What does this mean exactly? Well, I decided that I would just ask ChatGPT what it thought of the history of dividends paying stocks and rate cuts from the Fed. So I'll do some of my own due diligence and research on this later, but I thought it would be interesting to let you all know what the computer told this crab. So hey, the opinions expressed in this video are not even this one crab's opinion. They're primarily the opinions of ChatGPT, and you should always do your own due diligence before making any investment decisions. So let's try to make sense of this. What in the world does ChatGPT think about Federal Reserve Bank cutting the rates? Well, the first impact they pointed out is there's lower borrowing costs. When interest rates decrease, companies can borrow money more cheaply. Makes sense, right? This can provide them with more cash, which they may use to increase dividend payouts to shareholders. Okay. Next would be attractive dividend yields. As interest rates fall, fixed income investments like bonds become less attractive due to lower yields. Investors may shift toward dividend paying stocks for higher returns, encouraging companies to maintain or increase their dividends to attract these investors. Boost to profitability. Lower rates can stimulate economic activity, potentially boosting company profits. Increased profitability can enable companies to allocate more cash toward dividends. An impact on cash flow management. Some companies may choose to reduce dividends during interest rate cuts if they anticipate future economic challenges. This would lead companies to conserve cash for business operations rather than increasing payouts. But overall, interest rate cuts generally encourage higher or maintained dividend allocations, but the impact can vary depending on the company's financial health and industry. All of that makes a ton of sense to me. The good news is that DGI Crab channel only focuses on 60 of the highest quality dividend growth stocks that there are. These companies, the vast majority of them, have not only been maintaining their dividends, but they've been increasing them annually, year over year, decade over decade, through multiple financial economic crises. And, you take a company like Procter and Gamble or Johnson and Johnson or American States Water. They've been through an awful lot over the years. Okay, they are 60-year plus dividend increasers. So they've seen rate cuts, they've seen rates rise, they've increased their dividends throughout all of it. So the way that I look at it is that this is more than likely going to be good for the share price of these stocks, which in turn could mean that there are going to be not only dividend increases, but maybe larger dividend increases than we've come to expect recently. All of that's just a guess. None of us have any way of knowing what each of the individual companies are going to do. But of the 60 stocks that I focus on the channel, I would imagine that maybe the two business development companies or the BDCs in the tier 4 category for the 54 and older investors, maybe they will have a little bit of a problem because they make their money by giving out loans to smaller businesses that need the money. And if the interest rates on the loans aren't as high, then it would just stand to reason that they wouldn't have quite as much capital to give back, particularly with the special dividends that both of those companies tend to dole out on a fairly regular basis. I think that slashed rates should continue to be excellent for the REITs, the real estate investment trusts, which really were taking a pounding earlier this year, late last year. Late 2023 and early 24 was an excellent time to load up on real estate investment trusts because a lot of the quality REITs right now are seeing their prices going up on this news. And we're just going to have to wait and see overall what's going to happen here. But like with most macroeconomic news that happens out there, I'll pay attention to it, but it does little to nothing to stress me out because I've picked the highest quality dividend growth stocks. I'm going to invest in those stocks when they are yielding at least 20% higher than their 4-year average, so I can get them at a really good deal to give me the best shot at both price appreciation and acquiring the best yield on cost that I possibly can. That's the best that I can do, and that's probably the best that any dividend growth stock investor can do. So pay attention to this kind of stuff, you guys, but don't obsess over it. Just remember that if you're investing in the way that I do, you're focused on quality, not necessarily macroeconomics. You're building up passive income and you're just shutting out a lot of that noise because at the end of the day, most of it really is just noise and it doesn't make much of an impact on us at all. If you're rolling the dice on some smaller companies, or some companies that don't have the kind of history built up and established that the ones that I focus on follow on, then maybe you'll need to pay a little bit closer attention. But to me, that's a pretty stressful way to invest, and I just don't think there's any reason for it when there's so much quality out there to focus on. You can always find a good deal amongst this group of 60 stocks, and that paired with high quality ETFs are going to bring you in the passive income you need to make you wealthy, regardless of what the Federal Reserve Bank is up to. So anyway, those are my opinions and the feedback from the computer or ChatGPT. You can email me your questions and I will answer them in a much more personal way than ChatGPT will. Just shoot me an email at dgicrab@yahoo.com and check out the links in the description to the video below for links to each of the videos on the 4 tiers so you can see all of 60 of the stocks that I am talking about and what age range each of those stocks is most appropriate for. Take care, everybody. Thanks for watching, and I will catch you on the next one.